Mr. Mark Selby, how are you, sir?
Very good, Mr. Matthew Gordon. Our first, after the big 2023 forecast call, our first weekly session. So looking forward to that for 2023, which I think is going to be an extremely interesting year.
Sounds like actually most CEOs I speak to have come back refreshed and invigorated and optimistic for 2023, which is good news. Now we've got a slightly different setup there. Very nice, I have to say. Love the picture. For those listening, You should be watching the video. It's beautiful. We're going to talk about some company news today. Run through some results coming out, some quite interesting stuff from the world of nickel. But we can't not start with the overview of nickel prices, etc. So what are we seeing out there, Mark?
Despite lots of news, nickel prices hang in there pretty well. We've been bouncing off $26,000 a ton after being as high as $30,000 a ton over the December-January period. And, there was a huge amount of volatility. I can't help but think with the Chinese trying to get a lot of contract pricing priced off the Shanghai metal market contract, that perhaps they were helping along with that volatility during that time period to convince people to do that. But the LME still exists for the time being. Again, we've seen inventories tick up a little bit, sort of 4,000 or 5,000 tons, added. So we're, getting up towards $60,000 a ton. But since the start of the new year, we've seen those inventories come down again, heading back down towards the 52,000 ton level. So again, that's about 1 week of global inventory and very, very tight. Again, a lot tighter, given how much noise there is about, possible surpluses and China slowing down and. But again, it's not really showing up in terms of physical inventory on the LME, which will continue to be supportive for prices going forward.
And how do you see this going forward? Because we've seen in the world of mining and in industry, and production, this whole kind of the deglobalization. Realization caused by COVID, caused by supply chain issues, caused by surging prices through inflation and printing of money, that just-in-time strategy didn't work anymore for a lot of these companies. They needed to move to accumulating inventories as a backup for the just-in-case scenario rather than the just-in-time scenario. So do you see any changes in the metal markets from the buyers? With some of these metals, obviously we're talking about nickel, but more broadly with battery metals.
Oh yeah, no, I think for sure. I mean, this is, there was a globalization trend that was intact and was a multi-decade trend, that probably peaked about 7 or 8 years ago and is now starting to slowly unwind and I think picking up momentum. Again, just a great real world example of what that looks like is that Canadian Prime Minister, showed up last week at Vital Metals, is building a rare earth project up in the Northwest Territories. They're building a rare metals refinery in Saskatchewan. Again, it's great to see the Canadian Prime Minister show up at a metals processing facility. But, the fact that, he's taking that time, and it's not like it's Saskatchewan from Ottawa is not a 5-minute trip down the road. It's a good 3.5 hour flight from Ottawa. So I think that shows just how committed governments are to decouple their supply chains from potentially hostile governments. And so, I think in this case, the horse is out of the barn, and this is something that's going to unfold and be sort of one of those strong drivers, over the next 5 to 10 years across the entire metals complex.
Yeah, interesting. Well, it'd be interesting to see how the kind of North American complex unfolds as well. Again, we've been talking to a few CEOs who are the beneficiary of some US government money over the past few weeks. Canada is seen as a friend and, more importantly, a source of critical materials and minerals. I suspect we'll be talking about that a lot this year. People picking sides. Now, let's go to the other side of the world. Let's go east. Let's go far east, in fact, and talk about Tsingshan. Now, they're a big player in the space. So what's the news from them?
Yeah, so we've seen sort of several announcements. Again, they are the world's largest producer of nickel. They're the world's largest stainless steel producer. So, Big Shot gets his name deservedly, because they are a major player in the nickel space. And so, again, saw another one of those announcements that's kind of rippled around the nickel market, where they made the announcement that they're going to work with some copper refineries that are struggling and looking to repurpose those facilities and have them convert their product into a refined material. Again, not for me, not surprising, as we've talked about many times in this. We're in the middle of a transition where we're taking basically where discounts for NPI are the mechanism that clear the market today. We're in the midst of, we probably have another 12 or so months to go before enough matte consumption capacity gets built so that we get to a point where the LME price does become the clearing price once again, and all the discounts for these various products, end up being priced as you would normally expect to do, versus the average Chinese producer marginal cost. So this, again, this is a bit of a step out, but again, I think makes total sense in the context of two things. One is, the battery industry has not added enough matte processing capacity as quickly as they would like. So if you've got matte, the people who would like to buy it aren't adding enough capacity quite as quickly as you would like, then to say, okay, if you guys don't do that, your alternative is to go buy, LME deliverable nickel at a big fat premium. And so, okay, if you're not going to do that, well, then I'll go make LME deliverable nickel and I'll capture that big fat premium. So you're going to pay one way or the other. So I think there's two things there. One, it'll help discipline the market that if you want this matte, you're going to have to pay for it at a level that Tsingshan wants to sell it at. And then number two, again, as much as people say, oh, the LME price isn't real, blah, blah, blah. The reality is there's a lot of nickel that's being sold at a big premium to the LME price if it's an LME deliverable product. So there's a massive spread right now, and this is a great way to have that spread in place, and again give him the flexibility that he will have metal in a form that is deliverable there. So for me, this is a natural extension of this migration that's going to happen. And again, I think will help accelerate that and get to the point where, by the next 12 to 18 months, we're in a place where quote, we get kind of back to normal in terms of pricing basis.
What does it do for the West though? Because, Tsingshan doing this is great for China and that part of the world. But what are the implications and knock-on effects, positive or negative, out here in the West, where protectionism, in ecosystems, critical mineral lists, and so forth are the talk of the town?
Well, what it'll do, it'll make more LME deliverable nickel available globally. So today, some of that portion of LME deliverable nickel has to go to customers in Asia. That will then Tsingshan will displace that with material produced in that refinery, which will then make more material available, in the West for those kinds of uses that need, that kind of quality. And that's the reality right now is, again, as we've talked many times, is production in the West has been decreasing for the most part, for half a dozen years. And, the demand for in a number of applications that need high purity nickel continues to grow. So again, it's just it's not tricky. It's not complicated. It's just fundamental supply and demand. And you've got demand for a certain class of materials that exceeds the supply for it in the West. And somebody needs to step up and build some more smelting and refining capacity to be able to produce this material. And Tsingshan is stepping into the breach once again because the nickel industry is sitting on their hands.
Right. And as an investor, I'm looking towards the equities. Do we have any sort of sense of what amount of supply is going to be able to come into the market for the West? Because again, that's kind of a knock-on price effect on price, presumably, and therefore that's a knock-on effect on equities and the ability for me to make money. So, is there going to be a tidal wave? Is the market going to be flooded? What do you expect to see with pricing?
No. At the end of the day, the supply is going to come. It's just going to be in a different form, and it'll help to help fix some of these premium gaps. But what it is good from an equity investor perspective is the challenge when you get the NPI discounts having to blow out to balance the market. They pull the pricing of all the other raw materials, whether it's matte or MHP or concentrate. And so, the pricing for those intermediate products, which most mining companies would like to eventually produce, has been horrible over the past 6 months, and will continue to be horrible, for the next, 6 to 12 months until enough matte consumption capacity gets online so that this discount doesn't have to be the clearing mechanism anymore. So again, we're going to go through a little bit more pain, but this announcement is an important step to be able to get to the other side of this period where, the LME price will be once again be the clearing price, for marginal supply going forward.
Okay, interesting. And any other news from Tsingshan?
Well, that's the other part, and I think this really underscores, sort of the challenge here. And again, I think should give investors comfort that some of the doomsday supply, from Indonesia, it needs to be taken with a grain of salt. So Nickel Mines, who's now called Nickel Industries, is an Aussie listed company, who's effectively a public market proxy for Tsingshan's activities in Indonesia. So they purchased part of Tsingshan's operations. They've set up some new joint ventures in some of these big parks where they produce these metals. And again, the Indonesia story was originally this was a super low cost way to make nickel. They're going to make huge amounts of money. But what's interesting is, so one, Nickel Industries signed a bunch of, basically did a handful of deals with Tsingshan to pick up another several assets and the right to participate in some other ventures that are going on there. But as part of that, they provided their update on their fourth quarter results, and they talked about the fact that the EBITDA margins went from $2,200 a ton to just over $4,000 a ton. Well, during that time period, nickel prices were $28,000 a ton, on average. So what you're looking at is EBITDA margins in the September quarter of less than 10%. They've now, bumped up to a booming 15% EBITDA sort of pricing margin off the LME price. And again, it's two real factors which are really having an impact. So one is, yes, 3 years ago, Indonesian operating costs were cheap, were relatively low, closer to $9,000 or $10,000 a ton. But what we've seen a massive increase in coal prices. The Indonesian government boosted the formula that the price that the ore miners get, and so and that increase in coal price meant an increase in electricity price, and so those costs today are closer to $14,000 a ton. Which is starting to get up into the mid to third quartile of the cash cost curve. And so while you're producing something at $14,000 a ton, again, with those discounts that we just talked about that are existing in the marketplace, they're only getting, they're having to sell their product at a massive discount to the LME price, which results, in these really skinny EBITDA margins going forward. And the thing when you dig into this is the part that again people fall down on, when they talk about all this Indonesian capacity is coming online, it's going to flood the market with supply. That's really predicated on a Western view of processing capacity. And so in the West, when you build an industrial plant, the reality is it's a big chunk of capital. You've got fixed labor costs, which are effectively fixed, which are probably 50 to 60% of your operating costs, and your direct operating costs are maybe 20 to 30% of your operating costs. But your incentive, given that massive fixed cost base and the need to drive a return on capital that's invested, you want to run that plant, ideally at 105% of capacity. Way these operations work in Indonesia and to a similar extent in China, 90% of their costs are variable. They have to pay money to buy the ore, they pay money for the electricity, and they pay money for the coal as a reductant. and that's 90% of the cost. There's no incentive for them to produce a huge amount of material and sell it, at some sort of very small or even loss making to try and absorb the overhead cost. And so we've seen in a lot of the production, in terms of stainless steel, we haven't seen the growth in Indonesian stainless steel output, which you would have expected, given the continued ramp up on a bunch of fronts that way. So I think the market, and I think we've already seen it, is because of the cost structures, they're going to be way more disciplined about supply and production than I think a lot of people are expecting. And so, again, the capacity utilization in China in a lot of industries is relatively low, and again, I don't think Indonesia is going to be any exception in terms of what's going on there. So again, I think that's something that the market really doesn't fully understand.
I think it's a legacy issue about people's view of how China operates in terms of, oh, don't worry about it. We just need to produce the thing at the end of the supply chain. Everyone else in the middle doesn't need to make money. They do. There's been a big shift, certainly in terms, when we've looked at it around the energy complex, and mining in Africa as well. What they will and won't do these days. So yeah, they're there to make money. Okay, well, that's kind of an interesting commentary. Hopefully, people get something from that, and more importantly, feel a little bit calmer about what's coming down the line. So when it comes to pricing, we were talking before. Oliver Wyman report.
So obviously the big story in nickel over the last year was the big squeeze that happened in March, and LME nickel ceasing to trade. So Oliver Wyman, who's a management consultancy with the specialty in financial services and a place, the predecessor company I used to work at 20 plus years ago, they did a report for the LME in terms of trying to understand what happened, and not surprisingly, and again, I think it was something that was obvious. There's the LME market, but then there's a bunch of over the counter markets that trade in different hours, and again, the compliance. There's rules around disclosure of positions to the LME. But if you're not trading on the LME, then you don't necessarily, and you trade in these over-the-counter markets, so there's not the same obligation to provide positions on large outstanding shorts or long positions. And so, there were 4 big short positions that the market really didn't have visibility on, and then once people had figured that out, and some big longs started to come into the market and try to squeeze it, the inevitable result happened. So, I think that was the big so what. So again, we'll see whether they're able to get there or not. There's over-the-counter trading in anything is always a little tricky to try and wrap your arms around. So, we'll see. We'll see what actually gets implemented and see how successful that is going forward.
It needs something. Definitely needs something to change, but again, let's see what happens over this year. Company news. There's a bit people quite like. Why don't we kick off with Magna Mining?
Yeah. So no, it's after 12 to 18 months of high nickel prices and talk about it, we're finally starting to see the flow of durable results. And as I've said many, many times, we need all the nickel that we can get our hands on in this part of the world. So it's good to see some success. So Magna had picked up a property called Denison, which was the former Crean Hill mine that was operated by Inco until the early 2000s. They put up some pretty splashy drill intervals in terms of multi-percent nickel, copper, and PGMs, and it's good to see that. The only thing is I think from an investor perspective is, it is good to get those results, but I think it's good to be 100% transparent as to whether or not you're drilling into something that was a known resource, that there may have been drill intervals above and below what you drilled. So, in their graphics, those historical drill holes are shown as little lines, but there's no sense of what some of those intervals were. And so, hopefully going forward, they're a little more transparent and sort of help people understand whether they're drilling something existing and just confirming what's there, or whether they're starting to step out. But again, it'll be good to see a new deposit get going in the Sudbury Basin. One company we hadn't talked about for a while is Orford. Again, you have very seasonal drilling. You can only work there briefly in the summer, and they've got their joint venture with Wyloo. So the first set of results from the nickel exploration, some of the drilling, which was on some of the existing targets, had some okay, I wouldn't say outstanding, but what was pretty exciting were some of the surface grab samples where you had multi% nickel, multi% copper. Again, there's very few places left on the planet where you can get hit a rock and find multi% nickel. And this really is one of those few places. And so, and this land package is very, it's a massive package and is very underexplored. So, I think those results are an interesting sign of what might come, in next season's drill results. So it was good to see those happen. EV Nickel, our neighbor in Timmins, had started drilling their big bulk tonnage target on their properties, and so again, getting good grades with the right amount of sulfur. So if they're fully serpentinized, then they should be able to end up with similar types of grades and recoveries that we're seeing at Crawford. So again, it's just helpful to see confirmation of what the district potential in Timmins is shaping up to be. The other one that's in Ontario that was some pretty splashy numbers. Palladium one had a 10% nickel interval over a couple meters. So again, getting some pretty good nickel grades. The key there for that one is to be able to see whether they can string them together, over some amount of distance, to start to build some scale, to be able to put a decent size resource around. And then stepping out of Canada, one company I don't think we've spent too much time talking about is a company called Premium Nickel Resources. They picked up property in Botswana that was formerly owned by Norilsk and Leonore. It was closed when nickel prices fell back in 2010. I looked at it quite closely back in my RNC days. And so, again, this is a mine that had operated for several decades, and they're doing some additional resource drilling, looking for new targets that they think will work. And again, got some pretty decent intervals. The challenge there is, they were 1,500 meters deep. There's mine workings that go down, but it's when you're pulling stuff from 1,500 meters, it can get expensive. So we'll see what happens. But again, it's good to see some of those results coming through. And then with Canada Nickel, we got the rest of our drill results for Reed. Very happy. Again, we've said from the beginning that we do think this. There's a half a dozen Crawfords in this land package at this. Timmins is going to be a great big nickel district. And, what's exciting about what we've done at Reed is literally we just use the provincial geophysics that's publicly available. We've got a specific way we interpret it. We use that interpretation, and all 16 drill holes, hit the kind of mineralization that we wanted. The nice thing, these assays confirm, that the central core of this, is looking pretty good. And just the central core of it alone is as big as we have, is as big as Crawford, and the entire target is more than twice the size of Crawford. So, it's great confirmation that our targeting approach works, and we have literally more than 20 times the footprint within our land package that we have for Crawford. So, this is just one more check mark that says, this regional potential is really there. So.
Okay, well, congratulations on the discovery. Just on the debt repayment extension, because people will go straight to that. You've obviously delayed the study to be able to include the carbon credit, the carbon storage component. You're extending the debt repayment. Are those things? Are they? Well,
part of the original timeline for that debt was, in and around when we had expected to put the feasibility study out, which would be if one of the other financing things didn't come to pass, that would be a logical time to be able to be in a position to raise capital. I think the key thing there is we had the right within the original loan agreement to extend it 3 months. We're extending it, we had the right to extend it 90 days, or we're only extending it 45 days. Again, there's a number of financing initiatives underway. And so we're pretty confident that, one of those will get over the line in that time period, and we'll be well positioned to go forward to repay the debt at that time and continue to move forward. So
fine. Okay. I say 45 days, neither here nor there. Well, look, great catch up. First one of the year when it comes to actually looking at the market and who's doing what. I should say we need all of the above. We want them all to work. Mark, thank you for your time today.
Thank you, sir.